Calls and puts. Buying long options, calls or puts. Generally, buying long options is a segue from stock to options trading. Buying a long call or put will give you leverage that you won't have with stock. It's also the most simple strategy. For example, you can use these strategies in bullish or bearish manners. With long calls, a trader is going to pay a debit to purchase the option. Your goal is going to be that the underlying trades higher. With a short put, the trader is going to receive a premium for selling the option, with the goal that the underlying also trades higher. If you're purchasing long puts, the trader is going to pay a debit to purchase the option. Your goal would be that the underlying trades lower. With short calls, the trader is going to receive a premium for selling the option, with the goal of the underlying trading lower. Buying long options, calls. Using this strategy is going to come with some positives and negatives. The most obvious positive is going to be the highest potential for profit if the stock explodes higher. This is the number one reason why people generally get into trading call options. They want to have the ability to leverage their money. And if the stock really takes off, they want to have a way to profit off of that. Using long calls is a pretty simple and easy way to do that. However, this also is going to be a high risk strategy with the potential for big losses if the stock doesn't do what you want. Let's say you think it's going to explode higher, and actually the next day there's terrible news and the stock rolls over. Using this leverage strategy, that is going to be a moment in time where you can lose your money. That's why you always want to understand the debit that you're paying. Specifically, you also want to understand how long until expiration you have for your trade to work out. Because with a long call option, you're generally going to want to give yourself the gift of time, even if that's going to cost you a little bit more money. Because if the stock doesn't do what you think it's going to do, you want to have enough time so that your strategy can come back into profitability or at least can hang out around the break even zone while you're waiting for the trade to play out. Now, one great thing about long call options is that you can use them for account growth when it's done correctly. That's going to be combining it with technical analysis, timing, and also learning how to use strike selection in your options chain. So, focusing on what kind of delta you want based off of how long you're going to have until expiration, how much that's going to cost you, what that looks like from a risk to reward perspective. Because the thing about options is that they're priced so that they're going to lose money unless you know how to buy them, okay? Because options are decaying over time. And if the stock isn't going to, if it, the stock isn't going to make a big move, or if it doesn't make a big move, your options are just going to lose money. Okay. They're going to decay slowly until they're worth nothing. That's why you need to understand what kind of deltas to select, what kind of time frames to select. And most importantly, you need to understand timing with a setup. So, why do you think a stock is going to make a big move? Because you do really need to be able to select stocks that are likely to make a big move so that you can capitalize on those call options. So, as far as the options chain is concerned, this is generally the way that I have my options chain set up. I'm looking at the volume, the open interest, the delta. You can also use the theoretical price. That's a helpful pricing tool because that enables you to see, what if this stock does go up by 5, 10, $50, then what is my options contract going to look like? And that can help you effectively price out what kind of price targets you're looking for, what kind of percentage gains you're looking for, and it just also helps you be realistic about the movement in the options market. So I'm generally going to look at volume, open interest, because I need to know if there's enough liquidity. Um, you also absolutely have to look at the days till expiration, which is how long you're going to be in the trade. One mistake that newer traders will make is they'll say, "Hey, I don't want to pay more money for an option that's expiring in 30 days. It's really expensive, so I'm going to buy one that's expiring, tomorrow or in 7 days because it's cheaper." Well, the thing is that's a lot lower probability than giving yourself more time. So, yes, you do have to pay more um, for something that's more valuable because it gives you more time, but it's more likely to work most of the time. So that's why. Then also, your delta, that's going to tell you basically how much the option is going to go up or down in price based on the move of the underlying stock. So it's going to be a pretty important criteria as well. So, what is a call? Buying a call gives the holder the right but not the obligation to buy the underlying asset at a specified price before the option expires. So, why would you use those? To speculate on rising prices or to hedge other positions? Your profit can be unlimited. That's the really cool part about buying a long call. If there's some kind of news that comes out and a stock gaps up 50, $100 overnight, you're not capped. In general, when you're looking at directional setups, at least the kind of directional setups that I do, I generally try to target about 25 to 50% profit on the debit that I paid. So if my debit goes up, 25, 50%, that's a pretty good target for me. The whole, actually using the unlimited risk, or not the unlimited risk, but the unlimited reward potential really just doesn't come into play very often. So even though it is a possibility, it's just not something that I use as much because you just don't have very many of those situations where the stock just goes absolutely crazy. Now, what's great about these is that the loss is going to be limited to the premium paid. So whenever you buy a long call, the absolute most you can lose is whatever you spent. So when you're buying a long call, you need to have a price target. So here's just an example. This is a chart of Microsoft. Let's pretend that Microsoft is very oversold and it has a squeeze. And I think that this support zone at 315 is going to hold. And I want a trade that will allow me to target a return back up to this resistance zone at 330. You definitely need to have an idea for why you're getting into the trade. I'm not saying this is the best idea in the world. I'm not saying, go and do it right now. I'm saying have an idea. Here's an example. This is a Microsoft technical setup. How would you trade it, right? So in this example, I'm going to start off just looking at a long call. So let's pretend I'm trading Microsoft into 330. I want to buy a long call. This is a Delta 65 long call with 26 days until expiration. I just selected the October monthly expiration series just for an example because these are going to have more volume and open interest. They're going to have tighter spreads. This one is a little bit wide because I'm making this video when the market's closed, but normally the spread is not going to be that wide. So looking at the Delta 65, the max loss on this for one call is going to be $1,465. Now it will show you here the break-even price at 324. And currently in Microsoft stock is trading at 317. So what that's saying to you is, you need Microsoft stock to trade higher for this to make money, and to even break even because you're paying a pretty expensive debit. So if you're going to buy this long call on Microsoft, you need to be pretty certain. Obviously you can never be completely certain of anything in the stock market, but you need to have a pretty decent idea that it's going to trade higher because you're risking $1,465. Now, how could you know, let's say that Microsoft does trade higher, okay? How could you know what you may be able to close your option for? Well, you can add the theoretical price into the options chain and you can type in your price target. Now, I never try to target the exact price target at the exact date of expiration. You can do it, but it's going to be lower probability. So I usually try to get it within a week or two. So if I'm targeting Microsoft by 330, let's just throw in there, let's say that it gets there around October 9th and the stock is up about $12. What does that look like? I really do not like to ride my options all the way to expiration. Super risky. Stock can move a lot. Even if you have big gains, you can lose them quickly. So I like to take them off, a week and a half before. So let's pretend this scenario played out. Microsoft's up $12. It's up at 330. Here's the Theo price column right here. The option contract that I bought for around 14 and a half would be worth about 20 and a half. So $6 to $7, that's going to be $600 to $700 per contract of profit that I would make. if this idea came through. So that's kind of how I like to price it out. And again, how much can you lose? You can lose the max that you paid, which is 1465. Um, ideally, you would never lose that entire amount because you would use something like stops, right? You could use a 50% stop. You could also use a tighter stop that would be, let's say, below $315. So, maybe you lose 25% if it goes down below 315. So, absolutely, use a stop, even though you're using technical analysis to identify a price target or using some sort of percentage based gains to identify a target. Now, what if you're buying puts? What does that look like? Well, put buying gives the holder the right but not the obligation to sell the underlying asset at a specified price before the option expires. But usually we're going to be using puts to speculate on falling prices. You can use it also to hedge long positions in the asset, but most of the time you're going to see us, speculating on falling prices. Now, the profit potential is really big because it's going to give you in your platform, how much money could you make if the stock goes to zero? Because if you hold puts and the stock goes to zero, then I mean, you can make a killing, but how often does that really happen, right? Pretty rare, I would say. I can't say I've ever really seen a stock go completely to zero, but um, they do write that on there because in theory, if you're holding puts on something and it goes to zero, then you can make a killing. But we're really just looking at it as a speculative tool for when a stock falls from point A to point B, so you can capitalize on that directional movement. Now, what's great about these, just like calls, is your loss is going to be limited to the premium paid. So, why would you want to use a long put? Well, it has, the highest potential for a quick profit if the stock rolls over and dies. But, if the stock explodes higher, then you're going to lose money, right? You can use it for account growth when you're doing it correctly, but they're priced so that you'll lose money unless you know when to buy them. It's pretty simple buying long puts. You just, again, need to focus on how to select your strike, what kind of expiration series. You need to make sure you're giving yourself enough time. And then you need to understand how delta works so that um, you know, should I buy an in the money or an out of the money or an at the money strike to understand what you're risking. Because the thing is that if you aren't really selecting a favorable strike, expiration series, or delta, then your trade is probably just going to be low probability. And you don't really want to be putting money on the table when your trade's low probability. You can also make money on this trade when the underlying trade's outside of its regular expected move, which is the point, right? So if a stock is just kind of chopping around, you're really not going to make money on long puts. You need for it to make a big break, roll over, fall, so that it moves outside of the expected range, so that your puts can make money because your puts are going to lose money if the stock just trades sideways and nothing really happens because there's something called theta decay that will eat away at your option. So here's an example of a technical example. This is Zoom. It's a stock that's been, just on a continual death spiral. So this is something that I would look at to buy puts on. It's because you have a technical pattern, you're up against resistance, you have a squeeze, you have volume that's rolling over. So this is a good one that's a candidate for me for buying puts. So how would I make a price target if I wanted to buy puts? Well, I'd look at some Fibonacci extension targets. I'd look at some high open interest targets. I would look at a key psychological value. I'd look at a previous low. All of those things are going to line around $60. So in this example, I'm going to be showing how I would buy puts to trade Zoom into $60. So when you look at, selecting a put, in this example, I selected a Delta 65. Um, so that's going to be something that's going to be slightly in the money. The stock's trading at 68. I'm looking at the 72 put. That's going to cost me $4.55, which is going to be $455 in the options market. It's going to tell you your max profit is $6,745. That's because that's how much money you would make if, Zoom announced they're bankrupt and the stock goes to zero tomorrow. Don't get too excited by that because what you're really looking at, 25, 50% of the debit that you're paying, that's a more reasonable target on a long put. Yes, could you get 100%? Could you get 200%? Yes, you could, but I'm talking about day in, day out trading, not being a gambler, lotto trader kind of thing. So, to discover, how much you could really make, like let's say that Zoom really did fall to $60 by around October 9th. The reason why I selected that date was because it's decently before that expiration series. So there's some bad news. Zoom rolls over. It's saying that the expected move is $6 in that time frame. So that's why I put $9. Let's say it moves greater than the expected move. What would that look like? Well, those 72 puts that I'm theoretically paying, $4.44 for would theoretically be worth, 12 bucks. So, I mean, that's a pretty decent gain right there. It's actually even much better than the percentages that I quoted. Because the thing is that over time I've learned if you're a little bit more conservative, you can get more wins and you don't have as much stress and anxiety while you're watching your options trade around in the stock market. So, with puts, especially if you have a greater than expected move like that, you can end up cashing out pretty well because that would be more than a double, almost a triple on that option. So, in conclusion, long puts and calls are the most simplistic way to get involved in the options market and can carry the most aggressive returns, but they also come with substantial volatility and can come with some considerable risk, obviously, depending on how much you spend. They can also fit certain market conditions the best. For example, in a market condition where you're really getting a ton of directional moves, especially if there's a lot of short squeezes, right before earnings season. Those are times where it's really good to just trade long calls or puts. But there's also times where the market trades sideways where you're just going to get crushed in long calls and puts. That's why it's really important to understand a variety of options trading strategies. Um, and for me personally, a lot of the time I'm going to use spreads. So in the next section, I'm going to discuss how and why I use debit spreads. And I'll look forward to seeing you in the next episode.